Good evening, everyone. Welcome to our Maryland Homebuyer Workshop. My name is Jason Maida. I'm the branch manager with American Pacific Mortgage, and it's great to be with all of you this evening. We're going to allow all of our guests in tonight's call to be able to get a chance to join. So I know we're starting right at 6 o'clock your time. We're going to allow a few more people to file in. While we're doing that or waiting for those folks, just want to kind of give you just a kind of little preview of what to expect tonight. Tonight, we're going to be teaching tonight a Homebuyers Workshop. And what that workshop will entail is just to learn a little bit more about what it looks like to go through the journey of home buying. And so we get a chance to teach these classes every quarter to our Maryland alumni, and we're really excited to be in partnership with the University of Maryland. This is something we started earlier this year, and this is our second class from the University of Maryland. I was thinking about it earlier today. The last class we taught was right in the middle of March Madness, and I think actually that day the Terps were playing a game, and I don't know if I think we were on the wrong side of that game, but I think luckily we had quite a few people attend that class, and I think everybody else was probably a little bit more distracted by that game and maybe looking at that instead of attending the workshop. But that was our first class that we taught, and today will be our second class in our newly formed partnership with Maryland, and we're really excited to bring this information to you. We teach classes all throughout the country. So Maryland is one of our partnerships that we have with various universities. And so we're kind of growing that footprint of how we serve our communities with these home buying classes. So after you get a chance to view tonight's class, and we will have a recorded version that's available on our YouTube channel. We also will be sending all the material that I share with you this evening out to you via email. So just make sure that we have your email addresses, and we'll get that distributed to you. But we do teach these classes every quarter. So if you have friends, family, maybe some coworkers that you think might enjoy this content, we would love for them to either be able to check out some of the recorded versions that we have available or attend one of our live classes. All right. So just a little bit about me. So my name is Jason, of course. And again, in case you didn't hear it earlier, I'm the branch manager here with American Pacific Mortgage. And what we do is we specialize in leading with education in home mortgage financing. So we specialize with first-time buyers, but we get a chance to teach educational classes like this to first-time home buyers just like yourself, so you can understand the basic framework of home buying and really what does it look to get started in the process. Okay. So, we hope tonight that you're going to have one or two maybe takeaways that you can put in place, because, as you're kind of pursuing home ownership, we want to make sure you have all the tools, all the resources you can to help you be successful in this pursuit of home ownership. So let's look at what we're going to talk about today. So here's some of our talking points. We're going to spend some time looking at the housing market, and then we're going to have most of our concentration in the Maryland market. By the way, we're a nationwide lender. And so even though we're going to be kind of focusing tonight's content around the DMV market, we do service the entire country. So, if you're joining us from a different location outside of Maryland, maybe you're in the Midwest, California, Florida, whatever the case may be, we can still help service you through our office here with the APM. Now, some more of our talking points. We're going to look at a buy versus rent analysis. We're going to do some budgeting and what it looks like to be a homeowner, talk about credit and how that can influence your eligibility, but also the different program offerings that you have. We'll talk about student loans, those loan programs. We're going to kind of look at the 5 core programs that are available to you as a home buyer or a future home buyer. Talk about documentation needed for home ownership, some first-time buyer programs that are available all across the country. I'll kind of spotlight some availability in the state of Maryland. And then we'll kind of wrap up tonight's discussion looking at the loan process. What does it look like to get started in the process? We're going to take you through 6 milestones of home ownership, and we call it the 6 steps of home buying. And then I want to walk you through what a consultation looks like. That's where we design a specialized home buying plan for you. So when you do decide to take those next steps, you know exactly what your eligibility looks like. Okay, hopefully it sounds good to you guys. And let's go ahead and jump in. And before I do jump in, I want to say that this is a very interactive class. So, we encourage questions as we roll through tonight's slides. So if you have something that comes up, please use the Q&A function in Zoom. I'll answer as best I can on air. But will also carve out a Q&A session at the end of tonight's class. So if something didn't get asked or answered in tonight's session, we'll actually pick it up at the latter part. Okay. So when we think about buying, it's probably going to be one of the biggest investments you make in your upcoming financial futures. So it's a big deal. And, hats off to all of you that are coming off of a 3-day weekend and now jumping into a class on a Tuesday night. So, that's a big commitment in of itself. And, really this is the time that we're going to need to do our kind of our homework just to make sure we're in the best possible financial position for home buying. And when we think about the benefits of owning a home, there's a lot of great things that come with it. Now, first of all, you get a chance to control your own budget, so you don't have to worry about a landlord raising your rent every month. You have equity that gets created as that home hopefully goes up in value over time, and also as you pay down that balance. This is an asset, so you can potentially pass along that asset to maybe the heirs of your estate if you have like a trust set up. And there's still some tax benefits that come along with homeownership. And a lot of you maybe don't know that even though there was some tax changes in 2018, you still can potentially deduct interest when it comes to homeownership. Okay, so a lot of great things that can be there with homeownership. So when we look at a comparison of what we call as a rent versus buying, it's not really an apples to apples comparison. So what we like to do in these classes is get a chance to kind of dive in a little closer, kind of zoom in and look at what does it look like if I continue to rent? And we're going to go through a what if scenario right now, but if I continue to rent versus what is it going to look like if I decide to purchase? So we have this really helpful calculator that Freddie Mac gives us access to. It's an open site for you to take a look at as well. And in fact, we're going to include that link in our homeownership documents that we send to you, our presentation documents that we send to you tomorrow morning. So I want to walk everyone through a what if scenario on a rent versus buy calculator. Now, I do understand many of you are joining us from different parts of the country, so some of these numbers might not necessarily be relevant for your particular market. So just kind of bear with us. We would encourage you after tonight's class to maybe go back in and kind of run your own personal calculation and see what homeownership might look like for you. Okay. So I'm going to go ahead and just add in a few numbers. In fact, some of them's already pre-populated. And I know some of these numbers may be a bit of a stretch for some of us on tonight's call. So just kind of bear with us. First of all, for the rent side of things, we're going to put in a monthly rent of $2,500 a month. That'll kind of be our starting point. I assumed monthly renter's insurance of $15. And then we're also going to project out what we think our rent will go up each year we renew our lease. So in this scenario, I put 3%. We have for a home purchase. Now, this might be a little too high, might be a little too low, but we have a purchase price of $500,000. We also assume that our down payment is 3%. Now, you're going to learn a little bit more about down payment options in just a bit when we talk about loan programs. But the minimum down payment on a conventional loan at $500,000 is 3% or $15,000. We have our property taxes. Those will vary based upon the location of the home that I'm going to purchase. We have homeowners insurance that we estimated at $1,000 per year. Homeowners insurance is going to cover our property against certain perils like maybe theft, maybe vandalism. Potentially you might need flood insurance. In California, there's earthquake insurance. So it just depends on what's going to be needed to help cover your property. But we're going to assume $1,000 for tonight's discussion. We're also going to add in maintenance charges. So we put in $700. Now, if you think about it, if I bought maybe an older home that's probably going to need a little bit more TLC, that maintenance cost might be a little bit higher on an annualized basis. And then we also want to add in loan information. Now, typical for first-time home buyers is going to be a 30-year fixed mortgage. That's where the payments are fixed for the full duration of 30 years. Next section is interest rate, and that's going to be something we're going to dive in and talk about as a group tonight. We put in 6.5% as kind of a baseline rate for right now, but I want to share with you a little bit more about that in tonight's discussion. Now, origination charges are going to be what a lender is going to charge you for your financing options. And those are collected in what we call as closing costs. Closing costs in total, which not only just include the lender's charges, but they also include things like title, escrow, some of our attorney states, maybe attorney fees for the purchase transaction. But as a rule of thumb, we always encourage our clients to budget about 2 to 3% of your purchase price for those closing costs. Now, the next section is discount points, and that varies for every buyer because it depends on kind of how you want to have your financing structured. Rates, interest rates that is, are going to vary based upon the selection of product. And we're going to learn a little bit more about rates in just a minute. But as a consumer, you do have options in how you want to structure your rate through discount points. Discount points are additional costs that you can pay as a buyer to help maybe lower the cost of your interest rate. Now, what that looks like is, let's say I do have a 6.5% rate, but it's with no discount points. So it's not an additional charge to obtain that rate. But if I'm looking at my budget and I say, you know what, Jason, you really need to get to a rate of 6% because the market's not there, but if I get to 6%, it's going to save me X. So what you have the option of doing as a consumer is paying additional costs to help bring down the interest rate. Usually 1% of my loan amount is going to be the equivalent of 1 discount points. And as a rule of thumb, 1% cost will bring down my rate about 0.25%. Now, it does vary based upon when you lock in your interest rate and the lender that you're working with. But as a rule of thumb, usually 1% equals 0.25% reduction in interest rate. Now, the other settlement services tab or section is going to be for those other closing costs like the title, the escrow fees, the attorney fees. And so we kind of lump those together under that section. Now, the other assumptions I want to make is around my appreciation of my home. We forecasted out a 3% appreciation. That's going to vary based upon where you're at in the country, the market conditions. In case you don't know, real estate usually cycles every 8 to 10 years, whether that's up or down. Now we are still on the upswing, even though there is some challenges in the market. But even with today's interest rate environment, we still are seeing some subtle appreciation rates. Some other parts of the country tend to be flat, but we haven't really seen any retraction right now. And I know a lot of our buyers would like to see a retraction in prices, but we really haven't seen that at this point. Now we also projected expected years in the home, 7 years. Selling costs. Now that's an interesting one, because with selling costs as a buyer, first of all, when I buy my new house and when I take those next steps and purchase my home, I'm generally not going to have to pay for the use of a realtor. So a realtor is going to be someone that helps negotiate the offer of my home. Now, when I sell my home 7 years from now, then I could potentially incur those costs, because as a seller, you're usually paying for the buyer costs of their realtor, as well as the realtor that helps represent you in the sale of your home. Now, we also want to put in state and federal taxes. Of course, the state tax will vary based upon where you are at in the country. And then, of course, our savings rate. So what this calculator goes back and says, okay, well, first of all, I want to look at my budget, right? So my payments right now on my rent are $2,500 a month. I'm going to have to be expecting to step up my mortgage payment a little bit to like upwards of $4,200 a month if I was to buy a house. Now, we know that's a $1,700 increase in budget. But if that's something that's manageable for me, my total cost opportunity over 7 years is about over $40,000. Now, you may say, well, Jason, how did you get there with that savings? A couple of things. One is I'm controlling my payment structure, right? So I'm not worried about my rents increasing every year. So I got that kind of baked in. But more importantly, it's my equity appreciation over 7 years, and it's my tax savings that I'm kind of reaping the benefit of over 7 years. So when we think about budgeting, I would encourage you to kind of look at that as a deeper analysis, not just simply I'm paying $2,500 in rent and I can afford $2,500 in mortgage, because in the long term, there is some more upside opportunity. Now, we understand that for not everyone, they can jump up $1,700 a month in rent. We know it's not totally realistic, but at the same time, we would encourage you just to kind of take a little deeper look at your monthly budget. That's something we help our clients with as part of a consultation. Okay. Now, the other factor in home buying is where are home prices at? You just heard me talk a little bit about where the market's at. We're seeing slight increases, some flattening in certain markets. Haven't seen a bit of a pullback in values, but this is a snapshot of what the Maryland housing market looks like right now. Now, I want to kind of draw our attention to this number right here, which is 25 days on market. That's the median days on market. That's telling us is when a house goes to market, gets listed, how long is it taking for that home to sell? So right now it's about 25 days. When we were back right in the middle of the pandemic, we had a shortage of inventory, historically low interest rates, unprecedented lows. Those median days on market, if you probably look back, were maybe 10 days on market. I could even be a little bit high with that number. But the market has changed a bit. Of course, we're not in the pandemic levels of the market, but nonetheless, we still have some challenges as a market. Some of those challenges are around inventory. So there's just not as many homes on the market. So when buyers are out looking in the market, they don't have as many choices that maybe fit their search criteria. So what's happening in the market is we have limited inventory, still relatively good demand, even though interest rates are a bit higher. So it's still keeping prices stabilized or going up in some cases. So it's just basically economics 101, right? So we have low supply, we got high demand. So it's creating a stabilization of prices or a little bit of an uptick. This slide represents kind of what you're seeing in the market here. So in the Maryland market since 2023, we've had still a steady little uptrend in market prices. Median price on markets just over 400,000. That is median. So of course we have a little lower, a little bit higher, but that's kind of what we're seeing at as far as first-time home buyers and what they're looking at inside the market. Now, interest rates are playing a role in buyer behaviors right now. As I just mentioned, back in the middle of the pandemic, we saw rates hit unprecedented lows. Our lowest rate we saw, believe it or not, was like 2.5%. And at that time, it was obviously very favorable for buyers, but also a lot of existing homeowners took advantage of those interest rates, and they did what we call as a refinance. So they refinanced their homes to help lower their interest rate, lower their monthly payment, and create overall long-term savings for themselves. So that happened a lot. And then as we kind of move forward into 21, 22, first quarter of 22 is really where we saw interest rates start to kick up. We saw interest rates overnight going from that maybe mid 3 level. All of a sudden we start seeing rates at 4.5, and then slightly, or not slightly, but pretty abruptly going up even further. In fact, in the Q4 of 2022, we saw rates crest over 7%. Guess what? We just saw the same thing happen this week, or last week, I should say. Rates went over 7%, fueled by just kind of an unknown with the federal debt ceiling. Now, over the weekend, looks like that debt ceiling is going to pass. And so the market kind of did a reverse course today. The market improved by about 0.125%. So now we saw interest rates as of tomorrow morning are probably going to come underneath 7% to maybe 6.8. And if there's some encouraging signs around inflation, which we got some decent signs overseas, with Spain had some better inflation numbers today, so that's helping the markets here back at home. And then we're also seeing consumer confidence was actually a lot higher this week as well too. So a lot of those things are going to be helping interest rates hopefully kind of recorrect themselves. The big question we get asked all the time is, well, Jason, where are interest rates going? And it's really hard to kind of gauge that at this point. My sense is that we'll probably be somewhere in these low 6s to high 5s here for the next year or so. And then I think hopefully as we get beyond the challenges with inflation that the Federal Reserve is trying to kind of manage, we'll get rates to more of a kind of a normal level, which normal level probably means somewhere in the 4.5 to 5% range. Okay. Now, interest rates will look different for every client. There's a variety of different reasons of why that is. So, many clients will say, hey, I got this rate, but then I talked to my colleague and my colleague got that rate. And there's a variety of different reasons for that. One is credit eligibility. One could be loan products. So it depends on the program that they're selecting. Could be how much they're financing. If I have someone that's financing $1 million versus $150,000, that could look different. The down payment selection. So the minimum down payment is 3%, but if you put down 30%, that could help lower the overall interest rate. We talked a little bit about discount points, where I have the option as a consumer to pay more cost to bring down my interest rate. And then the last component is term. So usually when I take a lower term product, it's going to bring me a lower interest rate. Now, what's happening in the market right now is short-term rates are kind of intersecting 30 or more or long-term rates. So there's not as big of a benefit in short-term products nowadays. You also see that with adjustable rate products. There's just not as big of a benefit as opposed to long-term products. At the end of the day, for first-time buyers, while most of you are going to utilize 30-year fixed programs, it's really our job to help kind of customize and put together a home buying plan that helps kind of create the best product for you with the best available interest rate. Okay. Now, credit is the number one thing that's going to kind of drive those options with interest rates. And, as first-time buyers, when I consult with the hundreds of clients we do throughout the year, there's usually kind of two challenges for first-time buyers. It's usually either credit or it's down payment and just lack of resources for down payment. Now, we're going to talk about down payment a little bit later tonight, but I want to spend some time sharing with you credit and maybe some just recommendations on things that you can do as a buyer to prepare yourself for home ownership. So first of all, every product has a minimum credit score requirement. You can see those on the screen here. So we're going to spend some time talking about products in just a bit, but I also want to look at how a FICO score is made up. Now, many of you have FICO score or credit score kind of monitoring that's happening through Credit Karma probably, or maybe Experian, Equifax, or TransUnion. All those tools with those agencies are great. It gives you a lot of visibility to what's going on with your credit score. But there is 3 different models when it comes to credit scoring. So there's the mortgage model, there's auto, and there's credit cards. So those monitoring tools generally will be using the credit card score model. So I want to kind of share with you a little bit about what the mortgage model looks like. And here's kind of the weighted components of the FICO score calculation. So we have 15% of the weighting is going to be around how long I've had credit. So the more mature my credit file is, the better my credit score could potentially be. 20% is going to be how much new credit am I trying to access? So what that means is inquiries, specifically hard inquiries. So a hard inquiry is generally how most lenders are going to begin the process, whether that's auto lending or mortgage or even maybe a credit card, right? Now, as our process goes, we are going to start with a soft credit score. So that doesn't impact your credit score at all. So the 20% weighting here is going to look at how much credit am I trying to access? How many new accounts have I recently opened? All those are going to have a 20% weighting on the credit score model. The 30% of the weighting is going to be credit utilization. This is probably one of the biggest areas of opportunity for buyers is how do I get my utilization lower so my credit score goes up, right? So utilization is pretty easy. So it's taking your credit limits in aggregate versus your your balances in aggregate. So if I have $10,000 in credit limits, I have a $5,000 in balances, that means I'm at 50% utilization. As a rule of thumb, we really want to try to drive down utilization below, at least below 50%, but optimal below 10%. Now, I know some of the credit monitoring tools will say 30%. What I've found in my work with clients throughout the years is 10% really kind of gets us there. Now, let me give you a quick tip on how to manage your utilization. Now, when you look at your credit cards, you're looking at a monthly statement, right? Now that statement has a due date, also has a billing closing date or billing cycle date. Now, many of our clients, when they're having their credit accessed, the balances may show higher than usual. And what that generally shows to us is if our clients are, typically paying off their bills every month, they're probably just paying off their credit card on the due date. But the challenge with that, when you're trying to optimize your credit score, the billing cycle date is when the credit card issuer actually sends out the data to the credit agencies. So what I would encourage you to do is if you can manage your credit cards to the billing cycle date, not the due date, pay them off or pay them down before the billing cycle date ends, then that's going to give you a better credit score. So when it comes to applying for your mortgage, now you already have that lower balance. Maybe it's zero, maybe it's only a couple $100s. But that's going to allow you to have a better, more optimized credit score. All right, now the last component to the credit score model is going to be the payment history. That's kind of the one that kind of goes without saying, right? So payment history is going to occupy 35% of the credit score. So when we have late payments or anything like that, that's going to obviously put an negative impact to the credit score. The ratings of delinquencies are coded as 30-day lates, 60-day lates, and 90-day lates. So the more severe the delinquency, the more impact to the credit score. Now, any challenges that I've had in the last year or 2 years are going to be the biggest hit to my credit score. So in fact, I was just talking with a client earlier today. Their co-borrower had lates from 2021. They're kind of scattered through 2021. What my recommendation to them was, as we get past 2023, now we're going to be outside of 2 years since the date of the last payments. That should allow us to see a better, more improved credit score, maybe in the latter part of this year or maybe going into 2024. Account closure can impact your credit scores. That's when you basically close out a revolving line of credit. The challenge with closing out credit cards, because I know there's always these appealing offers from other credit card issuers, but when you close out an account, one is you can hurt your length of credit history. Two is if you have less credit available, then your utilization also gets impacted. So you just want to be mindful of that when maybe doing balance transfers and switching up credit card issuers. Now, when it comes to qualifying for a mortgage, we do look at all 3 credit bureaus. So the 3 agencies again are Experian, TransUnion, and then there's Equifax. So we look at the 3 scores, but then we take the middle score when it comes to qualifying. So if I'm at a 740 is my best score, 720 is my middle, my lowest is 700, we're going to take the 720 score when it comes to the qualifying. Now, if my partner's also going to join the application, we also need to look at the partner's credit, and we do take the lowest middle score between both borrowers. So if my partner's at 720, 700, 680, then we're going to take 700 as the middle score between both borrowers. That's what's going to be used for qualifying. And why that's important is because, as we learned earlier, interest rate is impacted by credit score. So if my partner has a little lower credit score, my interest rate offering might be a little worse, but it can also affect mortgage insurance. And mortgage insurance comes into play when I have less than 20% down payment. You're going to learn a little bit more about that in tonight's discussion, but those are things to be aware of, and we'll help coach you through that as part of a consultation too. This matrix that I'm showing on screen now is going to show you how long maybe past challenges will remain on your credit report. So things like hard inquiries are 2 years or less, but really the last 6 months of hard inquiries are really what's going to help, or not help, but hinder some of our credit report. Now we have a little footnote here about medical collections. So as of this year, medical collections should no longer be showing on your credit report, but we still haven't seen that put in play by the credit agencies. In fact, we were looking at credit reports last week with borrowers. They still had medical collections showing up on the credit report. So hopefully that's something that we'll see start changing over the next several months. Student loans are something that's going to be, just a part of being a first-time buyer. Usually for our buyers, I'd say probably 80% of our clients that we work with have student loans in some way, shape, or form. Some are smaller, some are larger, some are federal debts, some are their private debts. We do understand that the federal debts are in forbearance right now as part of the CARES Act. Now, a lot of those accounts are starting to go into repayment, I think in September of this year, if I'm not mistaken. But when it comes to qualifying for a mortgage, there's a few ways that we look at student loans, because we can't ignore the $50,000 balance. That has to be factored into the qualifying. So we have our example here on the screen, which is if someone had, say, a $75,000 balance and they had an income-based repayment amount of $250, now that's the payment we would use to help qualify for the mortgage. Now, we do have some clients that have graduated in the middle of the pandemic and haven't quite set up the IBR payment. Now, by default, an FHA loan is going to take 0.5% of that balance, and that's going to be used for the qualifying payment. Or on a Fannie Mae Freddie Mac conventional loan, it's going to be a minimum of 1% of the balance. So those are important things to know, because those could influence the eligibility when it comes to qualifying, because that FHA payment's $375, the conventional payment's $750. So just something to be mindful of. So we can't ignore the student loan balances. Now, there's forbearance, which is what the student loans are in right now. There's also deferment. Deferment's going to be when I'm back in school. Maybe I'm working on my master's program and now I don't have any payments. Even though those are in deferment, we still need to count a minimum qualifying payment for that buyer. Okay, questions? I know I gave you guys a lot already. I'm just trying to keep us on track for our timeline for tonight. Any questions on student loans, credit, budgeting, any of the information we've already shared with you? Okay. All right, cool. Again, if you have questions, we're going to use the Q&A in Zoom. We'll try to answer all those questions on air. And we'll also carve out time later on in tonight's discussion. Now, I want to switch gears. Let's talk a little bit about loan programs. And there's 5 core programs usually that we kind of talk about in our classes. And so with that said, I want to kind of dive into each one of those, kind of the characteristics, if you will, of each one of those programs. Now, I did get a question that came in, so let me just kind of answer that on air so we can share with the group back. Okay, so the question is, how long does the length of credit need to be for a first-time buyer? Great question. So generally, we need to see at least 6 to 12 months worth of credit history. Okay, so and for clients in general, if they don't have credit at all, some clients, maybe they've recently come to this country, or they just have never used credit. They've been kind of offline when it comes to credit. Usually it takes 60 to 90 days after you get a new account to have it appear on your credit report. All right. And then the other question that came in was to learn a little bit more about FHA. And that is a really great segue, because we're going to talk about FHA in the next minute or so. So let's talk about loan programs, conventional loans. So when we think about, you've probably heard the terms Fannie Mae, Freddie Mac, those are what we call as conventional loans. Fannie Mae, Freddie Mac takes about 70% of all originations across the country. The minimum down payment for a conventional loan is 3% of the sales price. Those loan amounts go up to $726 200. Now that's called the conforming loan limit. Those loan limits get adjusted every year right around November, and then they're in play for lenders to start the new year, new calendar year. A lot of lenders, especially big mortgage lenders like us, will put those new loan limits in place right around November, December, after we get an update from Fannie Mae and Freddie Mac. Now, Fannie Mae and Freddie Mac also has what they call as high cost of living areas, and it allows us to lend above 726,200. Now, depending on where you're joining us from, those loan limits will look a little bit different. Let's say you're in LA right now. LA County in California, maximum loan is $1,089,000. The difference with the product when we start going up to higher loan amounts is the minimum down payment jumps from 3% up to 5%. Okay, now the minimum credit score for conventional loans is a 620 credit score. Now we had the question come in about FHA loans. So in case you missed it earlier, the minimum credit score for FHA is 580. The minimum down payment is 3.5%. Now that also goes up to 726,200, the conforming loan limit. You do have the option on an FHA loan to go up to higher loan limits if you're in a high cost of living area. So some of our areas on the East Coast, will, let's say you're in Virginia, so you may have, a county like, that could have, closer to 7 or 8 or 800,000 in high cost or high balance loan limits. And so Fannie Mae has a website that we can look at and see, based upon the county that you're in, what that loan limit is. Now, FHA will follow that same kind of guidance, and they have their own website that you can see what the high cost of living areas. But different with conventional loans to FHA is 3.5% down payment, regardless if we're in a high balance loan or not. But 726,200 is a much higher conforming limit than we've seen over the last several years. And that's kind of what our guidance is in designing home buying options for clients. Now, VA loans are going to be for our veterans that have served. And if you're a veteran that has eligibility, you get a certificate of eligibility. And that's used to determine what your official loan eligibility is. And we help design products for clients utilizing the VA product as well. Now, the difference with VA is there's a 0 down payment option. You can even go up beyond $1 million loan amount and still have a no down payment option. Now, typically with VA loans, the minimum credit score is 620. Next product I'm going to talk to you about is the USDA product. That's the United States Department of Agriculture. And so they have different locations across the country that are considered rural areas. And those areas have special financing. There's 2 components or qualifiers to USDA products. You have to be in a geographical area that's considered USDA, and you have to meet the housing income limits, or household income limits, I should say. And so we can look at those across the country to see, if a particular buyer is looking at a specific area. Those loan amounts generally go up to 726,200. There is a no down payment option, so that's one of the big kind of features of USDA. And then in that scenario, we would only have out of pocket expenses for closing costs. Jumbo loans are going to be for our clients. They're going to be looking at probably trying to finance more than the conforming or high balance loan limit. With jumbo loans, that minimum down payment really jumps up. It jumps up to 10 to 15% down. Most clients using jumbo, though, will utilize 20% down payment. With jumbo loans, there's additional assets that are required. So typically for first-time buyers, we usually need, obviously, the down payment, our closing costs saved. But with jumbo loans, we're going to need to save both of those items, but also reserves. Reserves are what we show the lender that says, hey, I have more money left over after I've contributed my down payment in my closing costs. Typically, it's 12 months of my monthly payment in reserves. So if I had a $7,000 mortgage payment times 12, that's $84,000 I would need to have in some type of asset account. So that's a 401k, a brokerage account, checking a savings account, but those are assets I need to have left behind. Jumbo loans aren't going to be typical for our first-time buyers, but nonetheless, we always kind of like to share these with our buyers during our discussions here. Now, when we finance and we put less than 20% down, there's a thing called mortgage insurance, or PMI, private mortgage insurance. So what we like to do in our classes throughout the year is kind of just give you a quick, kind of a breakdown of what does mortgage insurance look like, when does it come into play, and how does it impact me for the different products that I'm going to kind of select over the course of my kind of pursuit of homeownership. So let's talk about conventional loans. There's different payment options for PMI on conventional loans. There's monthly MI, There's split MI where I can pay some of it up front. I can pay some of it on a monthly basis. There's single premium where I completely buy out the mortgage insurance. And there's also what we call as lender paid mortgage insurance. And so that's where you as a consumer can say, hey, Jason, instead of a 6.5% rate, I feel comfortable going up to a higher rate so I can completely buy out the mortgage insurance. So that's called lender paid mortgage insurance. And then mortgage insurance, very similar to interest rates, are not the same for all buyers, because when we look at PMI, it's based upon your credit score, what your down payment is, and then how much you finance. And so all those factors will make up debt to income ratio. What's interesting is when I talk to clients throughout the day, a lot of clients obviously begin their searches on Zillow or Redfin, and there's some really helpful calculators there. But on those sites, a lot of the calculators aren't calibrated with these characteristics of mortgage insurance. So you'll find often that many of the mortgage insurance calculators are going to be super duper high. So we would encourage you to download our APM mobile app. That has really accurate figures there. Of course, we'll help you through those calculations during a consultation, but that's pretty important because some of those calculators will show $300 or $400 a month. And as a buyer, you may say, wow, that's way too much. I can't afford that. But as you can see here, conventional PMI, if I assumed a 740 credit score, I financed about $450,000. My PMI is about $183 a month. So it's not as bad as you might be led to believe by some of those searches you see online. Now, conventional mortgage insurance does have a cancellation option. And what that says is that once I have generally 2 years in my original loan and 20 to 22% equity, I can apply to have that mortgage insurance canceled. Okay. Now, FHA mortgage insurance is a little bit different. In fact, there's two forms of mortgage insurance with FHA loans. There's monthly MI, which is 0.55% of my loan amount. There's upfront mortgage insurance, which is 1.75% of my loan amount. That gets financed in, by the way, so it doesn't impact your out-of-pocket expense. Now, FHA mortgage insurance cannot be canceled unless I decide to refinance into a different, maybe conventional loan. So that's one of the big distinctions between FHA and conventional. Conventional says, hey, no big deal. You can cancel it once you get 2 years, 22% equity. FHA says, I have to refinance into a different product. Now, FHA made some changes about a month and a half ago, which brought down the cost of mortgage insurance. So this 0.55% figure that you're seeing there used to be 0.85%. So it made, like in this scenario here, was about $100 difference in PMI. So that's a big game changer for clients. So FHA mortgage insurance, $206 a month, roughly on a $450 loan amount. But we do have to add in this upfront mortgage insurance of $7,800. That gets added in to the $450,000 amount finance. So as a buyer, as a guest of tonight's class, you may say, well, why would I really want to go with FHA, which sounds like conventional has all these great benefits? Well, there's a few different reasons. One is not everybody can fit into the guidelines for a conventional loan because there's different requirements that conventional loans have that maybe some buyers can't meet that they do meet with FHA loans. There's also lower credit score requirements with FHA. So there's a variety of different reasons. A lot of what we find is there's like different maybe past credit challenges that we can't overcome with conventional, but FHA is just a much better fit because it's a little bit more lenient from a guidelines perspective. Here's a good example. So let's say I maybe had some struggles last year and I couldn't make my payments on time. So I have a couple 30-day lates, a couple 60-day lates. That may be a little bit more problematic for conventional loans, whereas FHA would be a little more accepting of it because I can show the last 12 months, I've had really good payment history. Let's say I had a bankruptcy that was 3 years ago. Well, conventional loan needs us to be out of our bankruptcy 4 years versus FHA says, you know what, we're okay with that at 2 years. So it really just depends on what's the best fit for our buyers. And that's our job as we go through a consultation to kind of walk you through what, home buying plan makes the most sense for you. Okay, let's talk about documentation for home ownership and specific to income. And so as a W-2 wage earner, it's pretty easy because we just need the last 2 years of W-2s. We have tax returns that aren't always required, but we can kind of put that as a kind of a bookmark of those items. The last 30 days of pay stubs, we do verify your employment in some way, shape, or form. Usually that's a written and a verbal verification of employment. For our self-employed clients, it's going to be a little bit more labor intensive with documentation. It really depends on the type of tax structure you have, sole proprietorship, LLC, S Corp, C Corp, LLP, whatever the case may be. But as a rule of thumb, we are going to need to see the last 2 years of tax returns for self-employed individuals. Even if you're, let's say, driving for Uber part-time and you still have your W-2 job, we still need to see the last 2 years of tax returns for the business, usually a profit and loss statement, balance sheet, and then we do need to verify the business, whether that's through a CPA letter or maybe like a business license. All those things will be incorporated into the documentation for some of our self-employed clients. Okay, so a question came in, which is on point here for this particular part of our workshop. So question is, do employment gaps disqualify a person? And the answer is no. And guess what? As part of the pandemic, many of our clients have gone through gaps of employment, and there's a variety of different reasons, but a lot of it was just displacement from work, right? So had astronomical unemployment rates that impacted many citizens across our country. And so with that said, as long as there's a reason for it, where it's displacement, we can see past work history, then it's not an issue. Generally, as a rule of thumb, we do have to have at least 2 years total of work history and or education. So the example I like to give with a lot of our university classes that we teach is that, let's say I'm going to graduate from Maryland this spring and I have a job set up for me in the summer, full-time job. It's an accounting job, right? And I just got my accounting degree from Maryland. Because I've studied 4 years in the accounting field and now I'm going to work in accounting, that totally syncs up with qualifying for that 2-year requirement. Same thing kind of holds true with someone that has an employment gap too. So if I've, worked in, let's say, accounting prior to the pandemic, and then I got laid off in 21, now I'm back in work as a 23, as long as I can see what my new pay structure is, and I can kind of show my work history and or education, then I would still meet the qualifying. Okay. Now let's talk a little bit about time on job, since we're kind of a good segue here. So if you're working multiple jobs, then the 2-year requirement of, the gap of employment might be a little challenging, because like, let's say I'm in the healthcare industry and I work for one clinic for 30 hours a week, another clinic for 20 hours a week. If I do want to have both sources of income considered for qualifying, then I do have to be on both jobs for 2 years consistently. If I'm working a part-time job, so it's a part-time status, I do have to show 2 years in that scenario, because as a lender, we have to be able to evaluate consistency in hours. And if I have my hours that are kind of all over the board, part-time hours, then it's really kind of tough to judge what the actual income projection is going to look like. Now, if you're applying in just your name, then that's the only income that we can consider on the application. So even if I have a partner that's going to live in the residence with me and they're making a source of income, I can't consider that in the application unless they decide to join the application with me. Okay. And then I think I mentioned it earlier, if you have side employment, you're driving for Uber or Lyft or whatever, then we do have to show 2 years of simultaneous employment. So my full-time job, and then if I'm also driving for Uber, as long as I can show 2 years consistency, then we're good to go on using both sources of income. Now, when it comes to qualifying for financing, there's a calculation that we use in the lending industry. It's called debt to income ratio qualifying, or debt to income ratio calculator. And what that ratio does is it basically tells us what our gross monthly income looks like versus my expenses. Usually we want to see that debt to income ratio at 43 to 45% of the pre-tax income. Now, that's not necessarily a measurement for like affordability, because affordability is going to vary for every buyer. This is more kind of a qualifying guideline for you. And the 43 to 45% does have some flexibility to go up to as high as 50%. But the more important number is going to be affordability. And so that's something we're going to have a conversation about during our consultation with you to make sure we design a home buying plan that meets your needs, because we have a couple of big goals when it comes to designing home buying plans. Make sure, number one, it's sustainable, like I can continue to do this on a month in, month out basis. And of course, making sure it's affordable for me, because we all know there's a bunch of expenses out there that we have to take care of on a month in, month out basis. So we want to make sure home buying is really in line for us. And for some of our clients, now is not the right time. Maybe it's something we have to plan into, but at the end of the day, we want to make sure that that plan that we build for you is affordable and sustainable. Now, here's what debt to income ratio looks like. We take into consideration the principal interest, the taxes and insurance of the mortgage. We take in consideration the private mortgage insurance. Let's say I'm buying in a home development that has, maybe it's a gated community that has, restrictions. Those type of communities are are called homeowners association dues. A lot of condos, townhouses will have some restrictions in the HOA that you pay a monthly fee to. Let's say that budget was $2,500 a month, and then I have other debts of $500 a month. Then if I was to take my monthly expenses versus my income, $3,000 a month versus $8,500, now my debt to income ratio is about 35.29%. Okay, now for most of our first-time home buyers, they feel really good at 33 to 36% debt to income ratio. And so, it's really important for us to design home buying plans that really meet that budget. Now, 33 to 36% may look differently for everyone, but as a guideline to financing, you can go as high as 45 to 50% in debt to income ratio. Okay, so the next stop in this kind of home buying class is going to be figuring out what assets look like. If you remember earlier in tonight's discussion, we talked about two kind of challenges for first-time buyers: credit, which we've already reviewed. We've also talked about savings or assets for my home purchase to be able to put together, enough money, I guess, really to cover our down payment, our closing costs. And so let's look at some of the acceptable sources of down payment. Then I want to talk to you a little bit about strategies for down payment. Now, with documentation, we generally need the last 2 months of checking and savings accounts for your account that you're using for your down payment and closing costs. Could be deposits, transfers have to be all kind of sourced. We can't use any type of cash deposits. Retirement accounts, 401ks, 403bs, IRAs, those all can be potentially used, but I really would encourage you to talk to your tax advisor, your financial advisor, to find out if some of those accounts are not going to disrupt anything for you financially. Now, gift funds can be potentially used for home ownership. That's where a family member is helping to provide some support for you with home ownership. There is a way we document those funds, so we would encourage you to consult with us on that. There is kind of a process to go through with that. Usually gift letter, transfer of the funds from the donor to you. That's kind of what that looks like. So that's the documentation for the asset side of things. Now, I want to spend some time now talking about solutions for first-time buyers. We understand that it's challenging, especially in today's market where things are a little bit more expensive, to be able to have enough funds available, liquid, to go towards your down payment. Now, there is agencies across the country by state that help support first-time home buyers, specifically to low to moderate income households. And so we get a chance to partner with a lot of those different agencies across the country. And the Maryland Department of Housing also has their own program. And so I want to give you kind of a high level look at it. We would encourage you to connect offline with us. We're going to talk more about the options as your different home buying scenarios go to see what that could look like. But each state does have their own very similar products. Here in the state of California, there's a product. If you're out in the Midwest or anywhere around the East Coast, there is agencies that help support first-time buyers. So let me kind of share with you a few of these offered through the Department of Housing in Maryland. The Advantage 6000 provides a $6,000 no interest loan that can be used towards your down payment and closing costs. So that's a great tool for you. The 3% loan through the Advantage 3% loan provides a down payment that can help satisfy, remember, that 3% minimum requirement. And then the Advantage 5% loan is up to 5% of the mortgage for that down payment too. So a lot of these ways that we can help fill the gap when it comes to down payment. And then maybe instead of having to put together $18,000 from our down payment, maybe it's just funds to be able to put together for maybe our closing costs. Now, there's also flex loans available for you as well that allow you to get lower interest rates with no down payment assistance. There's the Flex 5000. Again, these are just options to kind of get you thinking about more about what homeownership could be for you. $5,000 no interest loan for your down payment and your closing costs. And then the Flex 3% loan for down payment assistance of 3% of the mortgage amount. Now, many of these products are going to have income limits attached to them. So what we can do is connect with you offline to see what plan best fits for you. But again, it's designed to help more low to moderate income households. So we really want you to be encouraged that as a first-time buyer, knowing that maybe I am limited on resources, there is help out there that can help maybe satisfy the need for down payment or closing costs. Many of the clients that we work with, especially for first-time buyers, they have as little as maybe $8,000 to $10,000 in savings for their home purchase. And so, programs like these can help make homeownership that much more of a near-term goal versus maybe making it a 3 or 4 year goal for you. Okay, so I want to now move over to our 6 steps of home buying. These are the milestones that we go through in home ownership. Now, I will have to say these milestones may look a little bit different, or the terminology might look a little different or sound different, depending on where you're at in the country, because there's different kind of rules and regulations by state. But I'm going to give you kind of a 10,000-foot view of everything. And then depending on where you're going to buy, obviously we'll customize a home buying plan for you from there. So step 1 is going to be pre-approval. And what that is, that's the output of a consultation with us. That's where we got a chance to design our product, make sure we feel comfortable with everything. And then we issue a pre-approval. It's telling the seller that you eventually present an offer to that you're certified for your financing. Okay. And that pre-approval is good for 60 days. So if you do have a longer timeline when it comes to doing your home search, we can always update your pre-approval at any time. Now, step 2 is going to be house hunting. That's kind of the fun part of this process. I know for many first-time buyers, it's a super stressful process. But step 2 is where we get a chance to maybe start with an online search. Then we maybe move to more of the face-to-face and going out and looking at homes in person. But we would always encourage you to connect with a realtor, because realtors are going to be experts in their market. They hopefully understand the trends in the market. They may be connected with their local sphere of influence in those communities to be able to know what's coming online, especially in a low inventory market like we have here today. So step 2 is getting connected with that realtor. And we have a fantastic network of preferred realtors across the country that we can always get you connected with. Step 3 is going to be entering escrow. So what that means is that's when I've now have a ratified contract with a seller, and that seller we've agreed to terms, and now we've opened escrow. Now that terminology may look differently depending on what state you're in across the country, but it means we have an accepted offer. Now it starts this escrow process, which is about 30 days. So from acceptance of offer to when I get the keys to my house, on average, it takes about 30 days. Now, as a buyer, within 2 to 3 days of that accepted offer, we do have to put together an earnest money deposit. And that deposit is usually 1 to 2% of our sales price. Those funds actually count towards your total out-of-pocket expense. So it counts towards the down payment, towards those closing costs that we talked about earlier. Now, within 24 hours of your accepted offer, we're going to give you a call really to schedule you for a follow-up consultation with our team. That's where we get a chance to meet with you one-on-one to make sure that we've had your financing designed properly, make sure we have all kind of the interest rate options, the closing cost options all built out for you correctly. We're also kind of in that process ordering your appraisal of the property to ensure the house is worth what you're buying it for. Your realtor is going to be ordering the inspections of that house. And then you have initial disclosures that are going to be sent to you within 72 hours of that consultation. Here's what an earnest money deposit looks like. It's kind of just, again, it's that 1 to 2% of your purchase price. It's money out of pocket, but it does count towards your total out-of-pocket expense. Now, in real estate transactions, and this does vary by state that you're going to purchase in, but there's usually what we call as contingencies. And contingencies allow you as a buyer to do your homework on the property. So it's not just, hey, I got my offer accepted with the seller, let's go get our keys, let's go move in. There's a process to go through, and that big part of that process is these contingencies. Allows you to ensure the house is getting appraised for what you're buying it for, allows you to get the house inspected, and a realtor will help orchestrate that for you. And then we have the loan approval, where the lender issues the loan approval for you. Usually the contingency is going to be in the first 14 to 17 days of your contract period. So if you were to look at it from this kind of visual tool here, it's probably going to be from step 3 all the way to step 5 of the milestones. So a question came in, which is just right in line with the contingency. If your purchase, so let's say your contract falls through, do you get your earnest money deposit back? So generally, yes, if you have that contingency protection. Some markets, you may not have that contingency, or you as a buyer may elect to completely just not have or waive a contingency. But as long as you have those contingencies, and then let's say you decide to back out of the transaction, you could still get a refund of your deposit. So especially for first-time buyer transactions, we really encourage you to have those contingencies in place to make sure you have that added layer of protection. Now, step 4 is going to be processing and underwriting. That's kind of the administrative task of the financing. So we check your employment, verify your assets. We'll probably have your interest rate locked in by that time. And what we're doing is we're preparing everything to go to the underwriting team so they can issue your loan approval. That happens at step 5. The underwriter issues the approval, and we're about that time, maybe 3/4 of the way through the process. And if you've done your homework, you've got the inspection back, got your appraisal, now you have your loan approval. So if you feel comfortable, you could potentially now remove the contingency or sign off on the contingencies, I should say. Now, at that point, you are kind of all in the transaction. So once you've signed off on your contingency, you've given the seller the A-OK that I'm okay with the process, I want to continue on. That's when your deposit would be at risk if you decide to cancel after that point. Now, as a lender, we're going to deliver to you a final closing disclosure at step 5. And that gives you a 3-day cooling off period before we get to the very last milestone. That's called closing your loan. And that's where you get a chance to sign loan documents in person with a public notary or attorney, depending on what type of state you're in, maybe an escrow officer. That process usually takes an hour to an hour and a half. At that in-person signing, you will have to then coordinate wiring of your funds or a cashier's check to settle up the final funds owed for the transaction. Once that's all transacted, then as a lender, we do one final audit of your financing. And if everything looks good, then we wire in the funds of the financing. And if maybe you've elected a maybe assistance program through one of our state partners, then we'll also finance that assistance as well. And that money gets reconciled by the attorney or the escrow team. And after that money is all accounted for, so in essence, the seller's receiving the proceeds they expected from the sale, you're contributing what you're supposed to as a buyer, both out of pocket and financed funds. Once that money is balanced out, then they'll record documents with the county recorder's office locally. Usually it's a grant deed that transfers ownership to you, and then a deed of trust, which is your agreement to repay the loan. And then guess what? After we get confirmation of that, then you become the official owner of the home. I got a chance to make a few of those calls to new homeowners today. It's probably the best part of my job because I get a chance to celebrate with buyers. And, it is kind of a stressful process. It's a lot of ups and downs, a lot of emotions that go through this. But at the end of the day, it's a huge celebration once we get to step 6, because this is probably going to be one of the largest purchases you make in your upcoming financial future. So it's a big deal. And we want to be there to celebrate right there with you. So as we think about moving forward, and if it's something that you're kind of interested in, you want to take the next steps in homeownership, or maybe you have a few questions after tonight's class, encourage you to get connected with us for an introductory phone call. That's where we do a 10 to 15 minute call just to kind of maybe understand a little bit more about how we can best serve you with homeownership. If you're ready to get going in the process, you want us to build those home buying plans that we talk about, whether you're going to buy next month, next year, or even further out. We love to help kind of strategize with you to put together goals and objectives for homeownership. So that starts with step 2 here. And you basically do an online application, you upload documents, and then from there, we meet with you for a video consultation. And we do those all throughout the day. This is kind of what that consultation looks like. And just so you know, it is a free service we provide. So we don't have any expectations other than we just want to help give you guidance and kind of mentorship and coaching in pursuing homeownership. It does start with a soft credit check, so you don't have to worry about your credit score being impacted, but we go through the plan with budgeting, affordability, location, type of property you're looking at, the interest rates offering, the closing costs. We want to have a comprehensive plan put together for you in homeownership. I mentioned to you earlier about the mobile app. So this is a great resource to do calculations, follow the progress of your loan. You can even really start the process right there on mobile. And I think I mentioned this earlier. First of all, we love our partnership with Maryland alumni. I think it's been a fantastic partnership. This is our second class that we're doing. We have 2 more slotted for this year, or maybe even 3 more. And we also provide a discount to you as Maryland alum. So we provide a $750 discount, which helps lower your lending costs and obviously lower your out-of-pocket expense. There's also other partnerships across the country that are listed here. And we would really encourage you, if you have friends, family, maybe even coworkers, we teach these free classes probably once to twice a week. So you can always check out mortgageeducate.com for our upcoming class schedule. Also, Chirps Mortgage is where you can see all the list of your benefits as well as our classes. specific to Maryland. Like I said, we teach many of these classes throughout the year, and a lot of our homeowners that have recently got keys to their house have graduated from these classes. So we would really encourage you to check out some of the reviews from some of our clients on some of our channels, like on Google and Yelp, because we're really proud of what our clients are saying about us in our local communities. And finally, I would just encourage you to follow us if you can on Instagram. We try to put a lot of good content out for first-time buyers, whether it's resources for first-time home ownership, whether that's going to be upcoming classes or just tips on credit. We want to make sure that we're giving you good, valuable content in your follow. So with that said, I do appreciate all of you joining tonight's class. We're going to open it up for questions. I know we're right at the top of the hour here, so I'm going to open it up for our first questions that are coming in right now, and we'll hang on with you guys until the last question's answered. So question just came in. How long does the process usually take from meeting someone on your team to buying a house? Well, that's it depends. So just to give you guys an idea of the process, so from application submission to consultation, it's usually about 24 hours. And then once you're pre-approved, you can start your home shopping. Home shopping can take some buyers 2 to 3 months, some buyers it takes 2 to 3 years. So it really just depends. Now, once we get to an accepted offer situation, then it usually takes about 30 days, okay? And the question came about, are we sharing this presentation? Absolutely. So we're going to be sending out all the material. The recorded version will be available on our YouTube channel. And then we'll get all of the deck page out to all of the attendees from tonight's class. Any other questions? So it's 7 o'clock out there, so I'm probably the last stop before dinner time. So I appreciate everyone, being patient and being participants in our tonight's class. Hopefully you found this information. Hopefully there's like 1 or 2 things that you could take away to help you on that eventual journey towards homeownership. Again, if you have any questions, we can help you with anything on that path towards homeownership. Here's all my contact information. Love to be able to connect with you.